Hello again! In this video, I'll do something slightly different. Instead of a previous historical era, the topic will be the Great Recession, the financial crisis that started in 2008. I'll explain what the situation had been before the crisis, what led to it, and how it was handled by the political and financial leadership. As usual, instead of just listing dates and names, I'll try to look behind the curtain to see if I can find something interesting there. Today, many people don't even remember the crisis, especially the younglings who were just children during this period. To be fair, I was also not paying attention at the time. I was busy making important personal decisions, so I didn't realize what the crisis was and what it meant for a lot of people. It was an extraordinary event, with millions of people losing their jobs and homes. And despite the enormous effort by different governments, the recovery was slow and gradual. It took us about a decade, although in some areas we never saw a full recovery, and then the pandemic came, starting another downturn. We associate the Great Recession with the housing boom, an unsustainable increase in real estate prices that directly led to a major crash. This is mostly correct. The bubble we had created in previous years had to pop eventually. Euphoria was followed by panic, sending all prices lower, reducing demand, and increasing unemployment. To understand what really happened, though, we have to go back all the way to the 1990s, when the Clinton administration in the US started pressuring banks to provide loans to low-income families. The idea was that these families should be able to buy their own homes, which of course could only be done through mortgages. So certain instruments, like credit default swaps, were exempted from regulation and housing rules were loosened. This way, low-income households could afford mortgages, which was a noble idea, but also the first step in the wrong direction. As it usually happens in politics, the next administration doubled down on this, greatly expanding deregulation, reducing oversight, and encouraging even more low-income people to buy homes. They saw this as the core of the American dream, which it never was, because home ownership has not much to do with rights, freedom, or upward social mobility. The government didn't have to pressure banks anymore. Over time, these banks realized that the booming market offered an exceptional opportunity. If they maneuvered carefully, they could offer more mortgages to risky clients, package these loans in a way that reduces risk, and then sell the loans to investors who wanted to earn a higher interest rate. This way, they got rid of the risk and increased their profits. But banks were not the only actors with questionable behavior. Before we get to that, let's see what instruments they were using. Back in the late 1970s, ordinary mortgages were securitized for the first time, which meant that thousands of these mortgages were packaged together, creating mortgage bonds which investors, mainly large institutions like pension funds, could purchase. The bank sold the bonds, the investors would get the monthly payments coming from the homeowners, they would also assume the risk in case delinquency rates went up and owners stopped paying. These mortgage bonds were assumed to be less risky, as they contained loans from all over the country, and since there had never been a nationwide real estate crash, the bonds received excellent ratings, even if they contained risky individual mortgages. The next step was the creation of CDOs, collateralized debt obligations, in the late 2000s, essentially packaging mortgage bonds together, so a single CDO would contain tens, maybe hundreds of thousands of mortgages. As time went on, the mortgages themselves became more and more risky, as the credit conditions were loosened. So people who could not afford houses, and in many cases had no income, no job, and no assets, were able to buy a mortgage simply because banks and mortgage companies wanted to keep pushing, even as they slowly became aware of the increasing risks. The more mortgages these companies were able to create, the more profit they earned, assuming they were able to quickly package them and sell them to investors who were hungry for more income in a world of low interest rates. Pension funds, hedge funds, and even foreign banks started buying US CDOs. They enjoyed the high interest rates on these instruments while the good times lasted. American homeowners, on the other hand, also enjoyed the good times, as the value of their real estate kept going up. Many of them started using their own homes as ATMs because increasing values allowed them to use the homes as collateral and take out more loans from the bank, which they could spend on consumer products and entertainment. Others purchased several homes and rented them out. As long as prices kept going up, they could pay the mortgage fees with the rental income these homes provided. Thanks to this process, in just 6 years, mortgage debt doubled in the US. The rate of home ownership came close to 70%, which was unprecedented, but the first warning signs started to appear. In 2006, housing prices stalled, then slowly started going down. But since everybody was incentivized to keep going, mortgage companies continued to push the so-called subprime mortgages. Lenders offered more loans to high-risk borrowers, even illegal immigrants, with no questions asked. Those who signed the contracts often didn't even know what they were signing. They just saw that getting a home was now very easy, so they played along. They had no idea about adjustable rate mortgages that lured people in with low initial payments, only to dramatically increase the monthly fee later on. A few smart and slightly weird individuals figured out that something was wrong. If the underlying mortgages are becoming worse, meaning that people with no money are buying homes, how can the CDOs still have an almost perfect rating? What about the synthetic CDOs, which are basically packages of other CDOs? These allow more investors to buy the same underlying mortgages, creating an enormous market with a high leverage. Even banks themselves invested in CDOs because they could use 30 times leverage, spending 30 times the money they actually had, profiting from very small increases in price. We are creating a bubble with worsening fundamentals and ever-increasing prices. If that bubble pops, everybody will try to sell at the same time, so US and international financial institutions, huge pension funds, and large businesses can go bust. They were right, but they didn't know when the crash would occur. These individuals started buying credit default swaps, CDSs, which act like insurance contracts. If you have a CDS on the housing market, you pay a monthly fee, but if the market goes down, the value of your insurance goes up. If there is a market crash, you can earn enormous amounts of money. At first, the banks were happy to sell these CDSs because they would get some money every month and the housing market would never go down, right? Wrong. By creating such a huge market using CDOs that often had fake ratings because nobody actually looked at the underlying mortgages, we laid the foundations of the next crisis, which would be not just nationwide, but global, thanks to the interconnected nature of financial markets. European banks and pension funds held US CDOs. When the American housing market started going down, these European institutions were burned. In 2007, housing prices did go down. Homeowners could no longer expect higher values. Paying the mortgage and other loans was becoming more difficult. Banks smelled trouble. They quietly started buying credit default swaps in case of a meltdown, while others still believed that it was just a temporary pause. Mortgage companies started shutting down as they could no longer push their subprime mortgages, and global investors were less willing to buy mortgage-backed securities. Major investment banks like Bear Stearns, who increased their own borrowing, expecting more increases in housing prices, were also in trouble. In their case, thanks to their high leverage, a mere 3% reduction in the value of their assets would have wiped out the entire company. It's no surprise that the bank collapsed in March 2008. In that same year, the question became which banks would be saved by the US government that started to bail out these enormous financial institutions, claiming that letting them go bust would be much worse. Lehman Brothers was allowed to go bankrupt. Other banks were either acquired or were given emergency lines of credit. AIG, which had sold huge amounts of credit default swaps, could not pay its obligations when the market crashed, so it had to be bailed out by the taxpayers. The Fed purchased toxic, essentially worthless assets from the banks to prevent a meltdown, but other central banks like the European Central Bank, the ECB, also did the same, while interest rates were cut to zero in many countries, making new loans extremely cheap. It would take years for the global economy to recover from the crisis, but in some areas like birth rates, a full recovery never happened. In the end, we can say that good intentions, misdirected government policies, and greed led to a global financial crisis. I'm hesitant to blame the banks for everything. They absolutely took advantage of ordinary people, but those people also enjoyed the good times. Their complicity and ignorance were necessary for the bubble to develop. After the initial steps, a program of quantitative easing, QE, was initiated by the major central banks, following the Japanese example, but its impact was questionable, to say the least. We can talk about these measures and subsequent events in another video, if there is sufficient interest. There's also an excellent book and movie on the subject, which I will put in the description below. See you next time.